Hey, what's up, everybody? It is Monday, September 22nd. First and foremost, I want to wish all my Jewish friends a Happy New Year, Happy Rosh Hashanah, Shana Tova. All right, so markets were up today. Actually, this morning we opened lower, and I sent out an email to my subscribers saying, you just got to keep buying the dip. We're not going to stay down. The flows are too strong, and bearish sentiment is still way too high. Okay, bullish sentiment dropped last week, but you still have bearish sentiment about 37% above the historical average, at least according to the AAII weekly survey. So today I saw another one of the, I don't know why, this thing even like affects me anymore, but I just look at this stuff. It's almost on a daily basis. So some guy at some outfit called the Lindsay Group, I never heard of them. I think he was, I don't know if he was a CEO or a market analyst or something, saying that the bond market is suspicious of long-term rates because of the fiscal health of, I think that was the term he used, the fiscal health of the United States. Folks, news flash. There's nothing unhealthy about the fiscal situation of the United States, at least in the context of what this guy is talking about, because what he was alluding to, like they all do, these debt phobes, like at some point that the United States is not going to be able to pay its bills, which is completely ridiculous because, once again, all of the liabilities of the United States are denominated in its own currency, the US dollar, of which it has the monopoly power to issue. And the rate on government securities all along the curve is nothing more than the expectation of Fed policy over that term. Okay? In other words, a 5-year yield would reflect what investors think the Fed policy is going to be over a 5-year period, a 10-year, et cetera, et cetera. You might say, well, how do we know what's going to happen? We don't, but the Fed communicates its policy in statements. That's why we all sit around every month watching our screens at 2 o'clock in the afternoon when the Fed has a conclusion of its meeting to see what they say and see what the dot plots. They try to affect the reaction function of investors. And I'll give you another news flash. It doesn't matter if the U.S. so-called debt, which is not really a debt, at least in the classical sense of what we consider as ourselves, household debt, that could be 100 gazillion, okay? And if the Fed wanted to keep interest rates at zero, it totally has the power to keep interest rates at zero, not just the policy rate, but again, all along the curve if it wanted to. So this stuff pops up nearly every single day. The thing that kind of shocks me, amazes me, not in a good way, is that you have educated people. Okay, a lot of these people went to high-level schools. They have advanced degrees, unfortunately, in economics. But even if not in economics, I've seen mathematicians, physicists, other disciplines, when they're talking about economics or the monetary system, make the same mistake, which is that they conflate the system that we operate under, which is, currency that floats, where the U.S. is the issuer of the currency, and it's not linked to anything. It's not convertible into gold or a fixed exchange rate, and they conflate that with something like the opposite, which would be a gold standard or a fixed exchange rate or something like that. Under the latter, fixed exchange rate, a gold standard, that view would be correct. That there would be some threshold where you could argue the fiscal health, the fiscal soundness, whatever you want to call it, may be called into question by creditors. But under the system that we operate in, which I just described, that's not an issue. That might be a political issue where one day, Congress says, for whatever reason, we're not going to pay. I don't think that's going to happen because I think at the very least, they understand, and it's funny because they understand it in a bad way. In other words, they think China is our banker, okay, stuff like that. I've had these conversations when I used to be at Fox News. Many times I'd be in the green room, waiting to go on air, and I'd be talking to somebody, well-known people. They could be from Wall Street, economists, policymakers, lawmakers, and we get into this conversation, and with a straight face, they're telling me China is our banker. I mean, not even trying to, try to think of the sequence. If we're borrowing dollars from China, which only we, the United States government, can create, how is it possible that China could be our banker? They first have to acquire the dollars from us. You see, so I mean, what I'm saying is that you get these people, very highly educated, but stupid, never questioning their theories, never questioning their understanding, even though there's been decades of operating under this system where they have been predicting disaster and doom, and it never happens. And it cannot happen simply because it's a different structure. It's a different system. Once again, if we were operating in a gold standard, if we were operating on a fixed exchange rate, that's possible. That could happen. No question about it. And I mean, it doesn't matter what the amount of outstanding government securities, which is not a debt, it's all been paid for. That's all the money that the government has created since the beginning, since the inception, 1776, 1787, wherever you want to call it, the Continental Congress. All the money that has been created, which hasn't been removed in the form of taxes. That is the stock, the global stock of dollars that has been created, which is held in the form of treasuries, which are government securities. It's like a savings account. It would be like your money being held in a savings account as opposed to your checking account. And every month, every day that rolls over, somebody's securities account gets debited, and then they get credited with a reserve account, cash. It's a very, very simple and mechanical operation. It's not a debt in the classic sense that we talk about as a household where, we owe something. It's not we borrowed from a bank or we borrowed from a financial company or something like that. No, it's not the same thing. They don't understand, and they continue to put out this nonsense. And that's why it never blew up, and that's why it's not going to blow up. It cannot. At least, from a monetary system operating perspective, it cannot blow up. From a political perspective, if Congress decides, hey, we're not going to make good on this, then yeah, that blows it up. But that would be a self-inflicted, that has nothing to do with the fiscal or monetary capacity of the United States. It has nothing to do with that. One is a political thing, would be a political decision. The other is just going to run under the structure and the system that we have in place right now, which it's just not going to end up in that debt doomsday scenario that all these people are talking about, simply because it's not a debt. It's just dollars held in the form of treasury securities. And if you look at a country like Japan, for example, that has, I believe it's something like now 1.4 quadrillion, okay? We got what, 37 trillion? So that's like 40 times. What would that be like? Not quite 40 times what we have, right? Nothing, no problem. They have a 0.5% interest rate, 1.4 quadrillion yen. So, I mean, the evidence is out there for these people. As I explained, they're educated, but they're stupid. They're dogmatic at the very least, which dogma means, stating opinion as if it is fact. It's not fact. It might be your opinion, but it's not fact. And they're just flat out stupid and stubborn, because there's years and years and years of operating and evidence where this has not happened, despite the claims and the warnings and the cries that it's going to happen, and it hasn't. You have to go back and look at your theories if it doesn't play out in the empirical evidence like you say it will. And you can't keep going on saying, well, one day. No, you do not understand the system. You don't understand the system. Under a gold standard, under a fixed exchange rate, that risk might be there. Under the current system, monetary system of how we are set up, that is simply not going to happen, okay? And as I say to you guys many times, if you automatically say there's going to be inflation because there's money printing, first of all, the money printing is driven by the non-government, not the government. It's driven by the non-government's desire to net save in dollars and to transact and clear in dollars. Okay? It's driven outside of the government, by the non-government. And if you say automatically it leads to inflation, you cannot call yourself a capitalist. I said this in my last video, because the basic tenet of capitalism is the profit motive. And if there's income in the economy, capitalists will find a way that will induce them to create the goods and services to grab that income, because that equates to profits for them. So, I mean, if you're going to say that printing money causes inflation, then you must prove to me that something in the system, something in the economy does not allow the economy to meet the demand of that additional income. You have to show me that that condition exists. Because if you just say automatically, reflexively, knee-jerk, that printing money causes inflation, number one, you're wrong. And number two, you're not a capitalist. You can't call yourself a capitalist. I don't know what you would call yourself, an inflationista, some kind of, just somebody who has this talking point in their head and is just going to spew it out no matter what. Okay? If you're going to say that you are a capitalist, you have to understand that the basic principle of capitalism is the profit motive drive, and that more income in the economy induces the private sector to create goods and services to capture more of that income. Profit. All right? Otherwise, you have to tell me and you have to prove to me that there is something in the economy which is broken, which inhibits or doesn't allow the economy and producers to meet the demand, which is defined by higher incomes. You got to show me that. Otherwise, you can't say it. Otherwise, you're completely and absolutely wrong. Okay? That's why you see, since 1980, and I could even go back to 1971 when Nixon took us off the gold standard, but I'll use 1980 because I know the number here, when the national so-called debt was 800 billion, okay, and now it's 36 trillion, and we have a 2.7% inflation rate now, largely, and we had a 20% or 14% something inflation rate back then, but we've had, what's that increase? A 5,000% increase in monetary growth. It just doesn't work that way. You understand? It doesn't work that way. And if you just spew out these talking points, then you're exactly like this guy from that outfit I just mentioned, who's talking about, I don't know, skepticism over the fiscal health or something like that. Believe me, it's healthy. Under in the context of the system we have in place, it's perfectly healthy. There's nothing wrong with it. Nothing wrong with it. So yeah. And this kind of stuff pops up every single day. It pops up in comments from these, very, very serious people on Wall Street who go on these shows. It pops up on these crazy blogs where people post up these big, long articles about what's going to happen and this and that, and this is terrible and that's terrible, and it's all nonsense. It's all nonsense. And the thing is, like, none of these people, and we're really talking about everybody with the exception of my little channel here and people who understand MMT, all of these people, they don't give a damn about thinking about what they're saying. And the fact that their predictions, they never come true. All right? Anyway, that's enough for that. As long as these fiscal flows remain as strong as they are, I've been saying this, risk assets, they're going to keep going up. Stocks are going to keep going up. Gold, everyone's piling into gold. I think it's way overbought. But I mean, if you have this money tsunami, okay, what are you going to do? I mean, we would need to see the fiscal flows slow down or contract, and I'm not sure if that's going to happen. Now, we're going to get our big monthly tariff hit coming up this week. Okay, last one in August was something like almost 21 billion. We're going to get this one probably Thursday or Friday. We'll see what that is. We had the rate cut, so that's going to start to work its way through the system in the form of reduced interest income transfers. We'll see that in the T-bills, which are right now, T-bill interest is down 42 billion over last year, but interest on other Treasury securities, it's keeping overall interest, it's still up by like 61 billion over last year. Got to pay attention to that. So we have two sources now of fiscal drag. It's not that they're new, but I mean, they're adding to it. So far, it hasn't had a negative impact. And, like, once again, I'll say this every single time. I look at my instruments, and my instruments, those are the fiscal flows. Anyway, that's it for today, folks. Thank you for watching. Please like and subscribe. And don't forget to go to my website, pitbulleconomics.com. Sign up for a 30-day free trial to MMT Trader. See you tomorrow. Bye.